In the pursuit of profits from the speculative markets, the most prevalent and consistently fatal error is that of premature commitment. The average individual, driven by an inherent desire to secure the best possible price, equates earliness with advantage. He sees a stock that has declined and perceives it as cheap. He witnesses the first flicker of a rally and mistakes it for the dawn of a new bull market. He acts on hope, on opinion, on the fear of missing out on the very beginning of a move. This instinct, while understandable from a common-sense perspective, is the very antithesis of sound speculative practice. The history of the market is a testament to the fact that the initial moves, the first signs of a supposed reversal, are more often than not deceptive. They are false starts, designed by the market's own mechanics to punish the impatient and to shake out the weak before the true trend reveals itself. Jesse Livermore, through a series of costly and painful lessons that cost him fortunes, learned this principle with absolute finality. He discovered that the most critical skill for a speculator is not the ability to forecast, but the discipline to wait for the market itself to provide confirmation. The trap of early buying is ever present, and understanding why the first moves are usually fake is the first great step toward moving from the gambler class to that of the intelligent speculator. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The greatest single enemy of a speculator is not external market forces, but the internal compulsion of impatience. The desire to be constantly engaged in the market, to have an interest at all times, is a weakness that will eventually lead to ruin. Livermore himself was not immune to this flaw, and the most illustrative and costly lesson of his career was a direct result of it. He had conducted a thorough analysis of the cotton market and had formed a definite and, as it turned out, entirely correct opinion that it was due for a substantial and prolonged rise. His logic was sound, his study exhaustive. He possessed the correct market thesis. However, the market itself was not yet ready to align with his view. It was in a state of lethargy, trading in a dull, narrow range, showing no signs of the imminent advance he foresaw. It was here that his impatience betrayed his judgment. He could not tolerate the wait. He felt the need to act on his opinion immediately. He entered the market, making an initial purchase of 20,000 bales. In a thin, inactive market, such a large order created its own artificial momentum. The price rose slightly on his buying. But the moment his buying was complete, the upward pressure vanished, and the market settled back into its previous state of inactivity. The move was a fiction of his own making. Frustrated by the market's refusal to perform, he grew tired and sold out his position, accepting a significant loss. A few days passed, but his conviction in his analysis remained unshaken. He re-entered the market, buying back his 20,000 bales. The result was an exact repetition of the first attempt, a brief buying-induced flicker of strength, followed by an immediate return to the doldrums. Once more he sold out, compounding his initial loss. This cycle of premature action and frustrated liquidation was repeated 5 times over 6 weeks. Each attempt was a testament to the correctness of his long-term view, but a failure in its immediate timing. In total, he lost nearly $200,000 trying to force a move that the market was not prepared to make. His disgust with his own lack of discipline became so great that he ordered the cotton ticker removed from his office, unable to bear the temptation it presented. The painful irony of this episode was sealed just 2 days later. With his capital diminished and his patience finally exhausted, the true market move began. Cotton started a powerful, sustained advance of 500 points, one of the greatest of the era. He had been entirely right in his analysis, but his inability to wait for the market's confirmation had cost him not only the $200,000 in losses, but also the $1 million profit that his correct position would have yielded. This experience was the genesis of one of his most fundamental rules. A speculator must not act on his opinion alone, but must wait for the market itself to confirm that opinion. The early moves he had tried to initiate were fake because they lacked the one essential ingredient for a sustainable trend: broad, organic buying power. His own buying was the only support, and when it was withdrawn, the price structure collapsed. This phenomenon is not an anomaly. It is the very nature of a market that is preparing for a major move. During these periods, which Livermore described as a narrow market, when prices are not getting anywhere to speak of but move within a narrow range, the forces of supply and demand are in a state of equilibrium. There is no clear directional pressure. The small, erratic fluctuations within this range are not the beginning of a trend. They are the signs of a market in consolidation. To act on these minor movements is to gamble on noise, not to speculate on a signal. It is an attempt to anticipate the move, and anticipation, Livermore learned, is the most certain path to financial loss in speculation. The intricate mechanics of these preparatory market phases were studied and systematized by one of Livermore's great contemporaries, Richard Wyckoff. While Livermore developed an intuitive feel for these periods of market inaction through his intense observation of the tape, Wyckoff provided a logical framework and a precise anatomy for them. He termed these phases accumulation and distribution. An accumulation phase is a period during which large, informed operators, whom Wyckoff referred to as the composite man, are quietly absorbing shares from the uninformed public. This is done with great skill, often involving the creation of deliberately confusing and misleading price action. There may be minor rallies designed to encourage selling from those who are happy to get out with a small profit, and sharp shakeouts designed to frighten weak holders into relinquishing their shares. These are precisely the fake moves that trap the early buyer. Conversely, a distribution phase at a market top involves the composite man selling his large holdings to an eager and optimistic public, a process also masked by volatile and deceptive price action. Wyckoff's methodology offers a detailed, logical way to analyze these phases by studying the relationship between price and volume, allowing a trader to understand the underlying campaign of the large operators. It provides a structured science to complement Livermore's intuitive art. For any student of the market who wishes to progress beyond simple price watching and learn to diagnose the market's true condition, the channel Richard Wyckoff Trading Methods is an invaluable resource. It offers a systematic education in identifying these critical market phases and avoiding the traps they set for the untrained eye. A link is available in the description. Having learned the immense cost of impatience, Livermore's entire approach was re-engineered around the principle of waiting for irrefutable confirmation from the market. This became the foundation of his business of speculation. He was no longer a gambler trying to guess the next move. He was a strategist waiting for the opponent to declare his intentions before committing his forces. His primary tool for this was the pivotal point. This was not some esoteric calculation, but a specific, historically significant price level that, once breached, signaled a fundamental shift in the balance of supply and demand. Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations, he stated. This was the moment the line of least resistance, previously ambiguous, became clear and decisive. He provided a concrete illustration of this principle. Consider a stock that has been trading for a considerable period within a range, for example, between $22 and $28. A speculator may form a very strong opinion that the stock is fundamentally undervalued and should eventually sell at $50. The amateur, acting on this opinion, would buy the stock at any point within that range, perhaps at $25. He would then be forced to endure a potentially long and frustrating wait, his capital tied up in a dormant position. He might grow tired and sell out just before the real move begins. The professional, Livermore explained, would have patience and wait until the stock becomes active, until it makes a new high, say around $30. The breach of this $30 pivotal point is the market's own signal. You will then know that market-wise you have been justified, he wrote. The stock must have gone into a very strong position, or it would not have reached $30. The move is on. That is the time for you to back your opinion. The early buying within the range is a bet on an opinion. The buying after the pivotal point is crossed is an investment based on market-confirmed evidence. The classic demonstration of this principle was his trade in Bethlehem Steel in 1915. After a period of being broke and in debt, he had secured a small credit line of just 500 shares. His first trade had to be successful. He could not afford a mistake. He was profoundly bullish on Bethlehem Steel and believed it was destined for a major advance. The stock was climbing steadily. At 80, the temptation to buy was immense. At 90, it was agonizing. Every point the stock rose without him was a reminder of the profits he was foregoing. Yet he held himself in leash. He waited. His pivotal point was the psychologically significant level of $100. For 6 long weeks, he did nothing but watch and wait, a period he described as the most strenuous of his life. Finally, as the stock approached par, his tape reading confirmed the immense buying power beneath it. He did not even wait for it to cross 100, but began accumulating his line between 99 and 99 3/4. The confirmation was immediate and explosive. The stock never looked back, closing at 115 that same day and reaching 155 within a week. The enormous profit was his reward, not for being bullish, but for having the discipline to wait for the exact psychological moment to act on that bullishness. Even with the signal of a pivotal point, Livermore's method required a final layer of confirmation. He never committed his full line of stock at a single price. He viewed this as a wrong and dangerous practice. Instead, he employed a method of market testing through pyramiding. His first entry was always a probe, an exploratory commitment representing only a fraction of his intended total position. He would, for example, start by buying 100 shares out of a planned 500. The market's reaction to this initial trade was the final and most important signal. If your first trade shows you a loss, he warned, why should you go to work and get more stock? He ought to see at once that he is in wrong, at least temporarily. A loss on the initial probe was an immediate signal that his timing was incorrect. The line of least resistance was not yet clear or was moving against him. The only correct response was to close the trade immediately and accept the small loss. If, however, the initial trade showed a profit, it was the market's way of saying, "You are right, proceed." It was a confirmation that he was in sync with the market's immediate momentum. Only then would he make his second commitment. And the most critical rule of this process was that each succeeding purchase must be at a higher price than the previous one. This is the principle of buying on a scale up. It is the very opposite of the amateur's disastrous habit of averaging down. By adding to his position only as the price moved in his favor, he was ensuring that his largest exposure to the market occurred only when he was being proven right, step by step. His own trades had to confirm his thesis. The fact that your trades do show you a profit is proof you are right, he explained. This method is the ultimate defense against the fake move. If the initial rally is false and the price begins to recede, the speculator is stopped out with only a small loss on his initial small position. He has successfully avoided the trap. If the move is genuine, he is drawn into the market, his position growing in size as the trend itself gathers strength. The psychological toll of this disciplined waiting cannot be underestimated. To watch a stock you are bullish on advance day after day without you requires a level of self-control that few possess. The fear of being left behind is immense. Yet Livermore understood that the psychological cost of premature entry is far greater. The speculator who buys too soon finds himself in a position that does not move. His capital is frozen, his mind filled with doubt. He becomes tired of waiting, his patience worn thin by the lack of progress. The chances are, if you had, he wrote, referring to buying too early, you would have become tired of waiting and would have been out of it when the move started, because having once gotten out at a lower price, you would have become disgruntled and would not have gone back in when you should have. This is the tragic fate of the impatient speculator. He endures all the anxiety of the wait, only to abandon his post just before the battle is won. The professional, by contrast, endures the anxiety of waiting for the signal, but once he acts, he is rewarded with immediate confirmation and a profitable position that provides the psychological fortitude to see the great move through to its conclusion. In the final analysis, the ability to discern a false start from a genuine trend is not a matter of clairvoyance or luck. It is a science of discipline. It is the understanding that one's own opinion, no matter how well reasoned, is worthless until the market itself validates it. The first moves are so often fake because they occur during a period of market equilibrium, before a true imbalance of supply and demand has been established. To act during this period is to gamble, to wait for the breakout, for the confirmation of the pivotal point, and to test the waters before plunging in. That is the business of a professional speculator. This entire intellectual and psychological journey, from falling into the trap of early buying to mastering the art of patient confirmation, is the very soul of the speculator's craft. There is no document that captures this struggle more vividly or with more profound insight than Edwin Lefebvre's classic Reminiscences of a Stock Operator. The book is not a trading manual full of simple rules. It is a psychological autopsy of a master, chronicling his evolution through his most painful mistakes and his most brilliant triumphs. To read it is to gain a glimpse into the mind of a genius. But to truly internalize its lessons and apply them in the modern era, the detailed chapter-by-chapter analysis by Max Davidson is an indispensable guide. It acts as a modern-day interpreter, translating the century-old market language and psychological battles into a clear, actionable framework for today's trader. It is the closest one can come to a personal mentorship with Livermore himself, a chance to learn not just what he did, but how he thought. If you are serious about escaping the traps the market sets for the amateur and beginning to trade like a professional, the link in the description is your next step.